Welcome, everybody, and thank you for joining the webinar today. Before we get started into the content, we'll just take a couple of minutes for my co-host and myself to introduce ourselves, the company that we work for, and we'll take care of a few housekeeping items as well. So my name is Phil Briggs. I'm a financial planner and associate portfolio manager at PWL. I'm coming to you today live from my home office just north of Toronto, where it is a pleasant in and around 20 degrees today. We're getting a little bit of a break from the humidity that we've had recently, so it's quite nice out there. And my co-host today is Jordan Carter. Jordan, why don't you say hello to everybody?
Hello, everyone. I'm as Phil said, I'm Jordan Carter, a financial planning associate at PWL, and I'm also in Southern Ontario, just kind of west of Toronto.
So Jordan Carter and Jordan Tarasov and I all work for PWL Capital, which, if you're not familiar with us, we are an independent Canadian wealth management and financial planning firm. We work closely with families across the country to help them plan and manage their serious long-term money. Now, in addition to the work that we do with clients, we are very passionate about increasing financial literacy for Canadians across the country. And so we produce a variety of content, such as this webinar today that we give away for free. And I highly recommend that you check out our website, pwlcapital.com. There you can find episodes of our team's weekly podcast, the Rational Reminder podcast, as well as a variety of different YouTube videos, blog posts, white papers on a whole range of topics, anything from technical investing in the stock market to the intersection of money, happiness, living a good life. There's a ton of content on there. You can spend many hours of your day, multiple days, going through it. And so highly recommend that you check it out.
Awesome. And for today's presentation, we're going to be using a program called Mentimeter. So this is going to allow us to ask you, the audience, a few questions, get some input on a couple different topics. And so just to be able to log into this, there's a website here. So go to menti.com and you'll be prompted to enter a code. So you'll see the code there just on the screen. You can just open this in another browser on your computer, or if you'd like to log in via a mobile or a mobile device or a phone, there also is a QR code that you can scan here as well. So we'll just give you a few moments here to get logged in.
And I do just want to jump in and encourage everybody to log in and participate in the presentation. It makes these way more fun if we get some interaction back and forth with the audience. For all that Jordan and I might like to think that listening to us just talk for 45 minutes will be enjoyable, you will probably enjoy and be engaged more in the presentation if you participate. So please do log in. Again, you can enter the code there or scan the QR code on your phone so that you can participate along with us. All right, shall we jump into the question?
Sounds good. Yeah, just to make sure everyone is getting logged in, we're just going to have a kind of a test pilot question here. Just which of the following is not a real account type in Canada? So there's a couple options, and so RSP, TFSA, IRA, and FHSA. And again, we'll just wait a few minutes here to get some responses, make sure everyone can get logged in.
Oh, look at this. Maybe this wasn't as hard a question as we thought.
Looks like we have a pretty smart audience today. Yeah, so that is correct. That the IRA is the answer. The FHSA, that's actually just a very recent account type. So there's definitely easily can be some confusion with that in Canada. So RSP, TFSA are all accounts in Canada, with the IRA being more of a term used in the US. So good job, everyone, for the first question here. I'm going to now pass it back over to Phil. He's going to kind of go over a bit of an overview of what we're going to talk about today and get us started on this retirement journey.
Yeah, absolutely. So here's our agenda. Now, the central theme of today's webinar is how to think about planning for your retirement, which I think for a lot of people can feel like a bit of a scary topic. I think for a lot of people that are early in their careers, it can feel a bit hard to connect to a goal that is 20, 30, 40 years away in some cases. And I've also seen it where people that are closer to retirement also find it a bit stressful, a bit scary, because it can be tough to figure out whether you have enough to retire, how you can ensure that your retirement is going to be successful, and to feel confident before you actually pull the plug on heading into retirement. And so Jordan and I help people at all stages of life plan for retirement. And we've designed this presentation today to focus on topics and questions that come up in our discussions on a regular basis. So we're hopeful that this information will be really helpful and valuable for you. And so to start, we're going to talk about how tracking your spending today is an important part of planning for your retirement in the future. We're then going to do a high-level overview of the pensions that most Canadians will receive from the government, the Canada Pension Plan, and old age security. We're then going to talk about inflation, which is a topic that has come up more and more recently with the high stretch of inflation that we've seen in Canada and around the world over the last 18 months or so. We're then going to take a bit of time to unpack the 4% rule, which is a common rule of thumb, very popular on the internet in places like the Financial Independence Retire Early community. We're going to talk about how it works and whether it's actually a helpful rule that you can follow as part of your retirement plan. And then finally, we're going to talk about investing your portfolio in retirement and how you can bulletproof your plan against potential market downturns. Now, to keep track of our journey throughout the presentation, I'm going to refer back to this diagram a couple of times. And what this is a simple depiction of what a typical retirement plan looks like. You can see that, the bottom left corner, when we're younger, we maybe don't have as much in terms of assets. And over time, our assets will grow as we save for retirement. Once we actually decide to retire, so that's the red line that you see there, our assets will gradually start decreasing over time as we use our investments to fund our lifestyle in retirement. And those are supported by the Canada Pension Plan and old age security, which themselves are like assets that provide a foundational level of income in retirement for Canadians. So we'll refer back to this a few times just to kind of keep track of where we are throughout the presentation. And so with that, let's dive into topic number 1. And as we start, I have a question for all of you, the audience. And I'd be very interested to see the responses here. I want to know what you think you need to save in order to retire in Canada. You signed up to be a part of this presentation today. I want to know coming in what you think, what you've been told, what you've read. Be really interested to see kind of where everyone is at as you come into the presentation today. And so I'm seeing a bit of a range, 1.7, 2, 3, a few, it depends. Nathan in the chat saying 25 times salary minus mortgage payment. Okay, that's awesome. Just give another, someone wrote 100 million USD. Yeah, I like the people that are, I like seeing depends. Yeah, we've got somebody referencing the 4% rule. So that is one that we're familiar with. This is great. I'm going to give 10 more seconds if anyone else wants to throw a response in there. These are all great answers. And I like that we have a range of different answers. We have some people that are putting specific numbers, other people saying that it depends. So that's great. So for all that this presentation is titled, how much do I need to save for retirement? I actually think that this is not a great question for us to ask. It's kind of the wrong question to be asking. And when you're thinking about how much you need to save for retirement, I think there are actually 2 better questions that you should ask yourself when you start thinking about your retirement plan. And so those questions are, number 1, how much am I planning on spending in retirement? And number 2, how much of that spending is going to come from my investment portfolio? Now, the reason that these are better questions is that the amount that you plan on spending in retirement is going to be the determining factor in how much you're going to need to save. If you think about it intuitively, it makes sense that someone who wants to spend $100,000 per year in retirement is going to need to save more than someone who wants to spend $50,000 per year in retirement. So the people that were saying it kind of depends are exactly right. There's no one number that applies to every single situation, which is why I always kind of find it a bit funny when a news headline like this one that came out in February throws out an attention-grabbing headline with some huge number that everyone allegedly needs to save. The reality is there's no one number that applies to everybody. And so let me give you a few different examples of different different spending amounts in retirement and the different amounts that would need to be saved in order to fund that retirement goal. So let's start off, let's say at $24,000 per year. This is what you're planning on spending in retirement. This is going to be very much, we're calling it the no frills retirement. Hopefully, you enjoy doing things for free, like going to the library or hiking in nature, which actually are things that I enjoy. So I don't know, that doesn't sound too bad to me. But the reality is if this is all you're planning on living on in retirement, you don't actually need to save anything. Your retirement is going to be 100% funded by the Canada Pension Plan, old age security, and potentially some other supplements that the government is going to provide for low-income retirees. And so at this level of income, you don't need to worry about saving anything. As long as $24,000 per year is going to provide you with a lifestyle that you're going to be happy with, you don't need to worry about saving for retirement. Now, if instead your goal is to spend more in retirement than the basic level of income that the government is going to provide you, that is where you're going to need to start saving. So spending something like $40,000 to $60,000 per year is going to require a portfolio of anywhere from $250,000 to $750,000 in savings. And if you're planning on spending even more than that, so let's say more than $100,000 per year, well, this is where you're getting into that, needing around $1.7 million or so. Now, these numbers are based on a 28-year-old couple that wants to retire at 65. They're not going to have any company pensions or anything like that. And so on the right side of the screen, you can see approximately what they would need to save on a monthly basis, anywhere from $200 to $1,300 between now and retirement in order for them to meet their goal. And so, Ed, I just see the question here, desired income after tax. That's correct. We're talking about spending. Typically, when we're talking about what we need to spend in retirement, we're talking about the after-tax number. And so I think a natural question, though, that comes out of seeing these kinds of numbers is, okay, so how do I determine then for myself which of these income levels I fall into? Like, how do I figure out how much I'm actually going to spend in retirement? And so I think a helpful practice to figure that out is to actually start tracking your spending today. This will allow you to figure out how much you're spending on your current lifestyle, which will provide a helpful starting point for figuring out what your lifestyle might look like in retirement. It's also going to help you figure out what you have available on a monthly basis today to save for retirement. Now, you can safely assume that you'll be able to live on a bit less in retirement. I think somebody else mentioned that in the chat as well, because in retirement, ideally, you'll be debt-free, so you won't have a mortgage payment or anything like that. You'll pay less tax because if you're living on less income in retirement compared to your working years, you're going to pay less income tax overall. And then the other big thing is you're not going to have to save for retirement anymore. And so you won't need as much income coming in as a result. And so to conclude this section, the big point here is that your spending is the thing that is going to determine how much you need to save for retirement. And tracking your spending today is going to be a helpful starting point for figuring out how much you're likely to spend in retirement. And as I've mentioned a couple of times, and I think I saw some questions in the chat there about this as well, the government is going to provide a nice foundation to get you started in retirement. So Jordan's going to take over and explain some of the things that you need to think about related to Canada Pension Plan and old age security. So Jordan, take it away.
Yeah, thanks, Phil. And yeah, as Phil mentioned, we've kind of touched on the expenses that will be incurred in retirement. And now we're going to turn our attention to kind of the other end or the other side of it. And where is this money going to come to pay for our spending in retirement? And we're going to start with two well-known kind of the two government plans that are kind of the foundation of any retirement spending strategy. So they are the Canada Pension Plan, so CPP, or the Old Age Security, OAS. And both of these plans, they do have some complexity to them. So we're gonna focus less on how they're calculated and and more so on the income they can provide in retirement. And so we have a question here for the group that we'll bring up for everyone to look at. And so your Canada Pension Plan benefit is determined by, and there's a couple options here, your residency, your contributions, or the size of your investment portfolio. Looks like there's lots of answers coming in here, and it looks like, again, a pretty smart audience as well. So yeah, the correct answer is your contributions. And so we'll go into a few more details about the Canada Pension Plan. And now when you contribute to the pension plan, you're contributing during your working years. So the contributions are taken right off of your paycheck, similar to income tax. And there's a maximum amount you're going to contribute in any one given year. So for 2023, that amount is around $3,700. And it is important to note that your employer also makes contributions on your behalf. So for anyone who is self-employed or thinking about going in that direction and making that transition, it's something that just make sure you're keeping in mind. And now, you've fast forward and you've been contributing to CPP over your working years, and you get you're coming upon retirement. You have to kind of look at what that benefit is going to be. So what's that amount that you're going to start receiving? And so the maximum monthly benefit amount that you can receive at age 65 is just over $1,300. And this is based off of the contributions you make. So if you've taken years off during your working years, or there's some low income years, that it won't be as high as that. And I think there's been a couple of questions. So yeah, it definitely does depend when how long you've contributed. So it's kind of between your ages of 18 and 65, and how much you contribute to those years and what your income was during that period. And so once you're kind of getting towards this decision of, are you going to start taking CPP? There are some options, and the amount that you receive can change depending on when you elect to start receiving it. So you can kind of see here the bullet points looking at if payments are taken before 65, that amount is reduced. And if they're taken after the age 65, the payments are actually increased. So there's a fair bit of variability as far as what that amount will be, depending on when you take it. And there's because of this, there's a lot of discussion kind of ongoing about when is that optimal time to take CPP, and what does that look like? And kind of to help illustrate this, we're going to go over a bit of an example here. So here we have a couple of individuals. So Joe, Nick, and Kevin, and they each are they're going to retire here. They each had similar salaries during their working years and contribute to CPP in similar manners. The only difference upon retirement is they're going to they're going to elect to take CPP at different ages. So you'll see here, Joe takes at age 60, Nick at age 65, and Kevin at age 70. So you can kind of see the difference in those monthly amounts that they will receive based on when they elect to take it. And we're going to thanks, Phil. And as we kind of look at this, we're going to look at a bit of a graph here that shows the difference in the total CPP lifetime received based on different ages. So you can kind of see here, just to give you some idea. So it's the age across the bottom and that total amount of CPP received along the side there on the y-axis. And just to give you some clarity there, you'll see Joe's kind of in the blue line. He gets an earlier start, but that blue line's kind of more relatively flatter versus some of the green or the gray, and that's more due to his lower monthly amount that he's receiving. You'll see Nick there. So once he starts receiving, his is a bit steeper. Just again goes back to those higher monthly payments that he is going to be receiving. And one way to look at this kind of outside of the financial industry and kind of to give you some context around it is, if you assume Joe and Nick are neighbors and they both like to stay active. If we look at a scenario where maybe one morning Joe leaves the house and goes for a walk, he'll be getting a head start on Nick. But now that Nick's kind of up and decides also to go out, he's going to actually go for a run. So he leaves 20 minutes after Joe. So Joe again has that head start on Nick, but Nick's running versus Joe's walking. Assuming they're both in somewhat comparable financial or physical condition, we know that Nick is eventually going to catch and surpass Joe. he just needs that as long as they exercise kind of for a long enough period of time. And it's very similar with these CPP benefits as well. So we know that Nick is going to be receiving more in total CPP benefits than Joe, granted they live a long enough life. And if we want to include kind of Kevin within this example as well, you could almost look at him as, he's going to leave later than both Joe and Nick, but he's, instead of, walking or running, he's on his bike. So we know, again, he's going to catch up to both Joe and Nick and surpass them again, given that he has a long enough runway. And that's, again, kind of shown in this graph, is with those later years, beyond age around maybe, or, above age 81 or so, that Kevin is going to start receiving higher total contributions or total payments. And so, yeah, to kind of just we'll kind of switch gears here and also just look at the other pension program that we mentioned. And so this is looking at the old age security. And we talked a bit about how the Canada Pension Plan was based on the contributions. The old age security is actually based on the number of years you've been a resident of Canada. So it has nothing to do with the income, whether you're working during those years. It's strictly based on if you're a resident of Canada and what that time period looks like. The maximum benefit is for 2023 is $760 a month. Again, this kind of assumes that standard age of age 65 of collecting these benefits. But similar to the CPP, you also have the ability to defer. So you can defer to age 70 and increase that monthly benefit, but you don't have the ability to take it earlier. So age 65 is kind of the earliest you can take old age security, unlike the CPP. And one final note just on the old age security is it is important to know that it can be income tested, meaning that if you make too much taxable income in any given year, there is your old age security could be clawed back or reduced. And for that amount in 2023 is about $80,000. So if you earn above that amount, you do start to receive a lower amount of OAS. And we'll kind of come back to our example here. We won't spend as much time on this one, but for Joe, Nick, and Kevin, again, if they are going to retire and start taking OAS, again, here we have three different scenarios where they're going to take it at different ages. Joe's going to take his early again, and Kevin's going to defer as long as possible. And again, the graph that we'll kind of show here really just kind of illustrates that point that there is a benefit to deferring and collecting those CPP and OAS benefits. And the longer you can defer, the benefit becomes more apparent the longer you live as well. So the further out you live, the more that benefit's going to be accrue to you. And just kind of some longer or some conclusions, I guess, about these plans. Again, the big thing is just those longer life expectancies are making these deferring options more attractive. So again, if there's no reason to believe there's a shortened life expectancy, or there's not a very urgent cash need in retirement at the onset, deferring these as long as possible, it does make a lot of sense for the stability of your retirement spending and making sure you maximize these benefits. One thing to be aware of, though, is investment. We kind of the illustration on this one is, for the example, if you were to retire it at age 65 and it's not start collecting CPP or old age security until age 70, there is going to be a period of time there where you're going to need to be funding your lifestyle and funding your spending from some other means. So whether that be some part-time job or from your investments, as we have kind of illustrated here, there is going to be a need to find income sources if you have retired prior to collecting those benefits. And then I guess the other big thing that we'll talk about here, and we're going to go into a bit more explanation here shortly, is those larger benefits. They are indexed to inflation. So it's something where both the Canada Pension Plan and the old age security are will both increase as inflation increases. So you'll get a boost for those monthly payments each year, depending on how the cost of goods and services kind of increase as well. So again, it really protects you in your later years as those inflation protection really takes hold. And Phil's going to kind of go into this next section about why it is so important to have some inflation protection within your retirement spending or retirement income as well.
Yep, absolutely. Now, before we jump into inflation, let's just check back in on our retirement plan diagram here. So we've covered sort of the first two things in this diagram, the initial accumulation years, the fact that the amount that you plan on spending in retirement is going to determine how much you need to save, at least for the portion that's coming from your portfolio. And we've also covered the foundational amount of income that the government is going to provide in the form of Canada Pension Plan and old age security. And so now let's talk about the stage that's at the red line there, the retirement years. And we're going to talk about some of the things that we need to think about once we actually start drawing down our portfolio in retirement. And so as Jordan mentioned, the first thing that we need to think about is inflation and how inflation is going to impact our plan. And so to start this section off, I have another question for the group, because we hear the term inflation get thrown around a lot. And I want to make sure that we all understand what it is that we're talking about when we're talking about inflation. So just a simple question: inflation is a measure of government spending, a measure of price increases, or a measure of economic growth. What do you think it is? Perfect. Everybody is piling into the correct answer, which is always great to see. Even if you didn't know the answer, you can just follow the crowd and end up being right a lot of the time. So the correct answer is that inflation is a measure of price increases. And when we're talking about price increases, we're talking about the increases of prices on the goods and services that we consume over time. So as the economy grows and wages increase, the prices of goods and services that we purchase with those wages will increase as well. And so here is an example of what this has looked like historically. I will say that this is a US-centric example, because there's no way that coffee at Starbucks or even Tim Hortons only costs $1.85 today. I'm going to assume this is Dunkin' Donuts or something along those lines. But the idea is that a cup of coffee only cost 25 cents back in 1970. And up to today, it has increased in price by 7 times that amount. And so for someone who retired in 1970, they can't just set their budget for their daily cup of coffee at 25 cents and leave it there forever. They have to account for the fact that their cup of coffee is going to get more expensive over time. And this is true for groceries, clothing, housing, vacations, anything that we might consume. Even if we think back to our no-frills retirees who were living on $24,000 per year, they are actually going to need to ensure that that $24,000 of income increases throughout their retirement so that they don't lose what's called purchasing power in retirement. The idea that the income that they have coming in buys them less goods and services over time. That's what I mean by losing purchasing power. So $24,000 will buy them a certain amount today, but it's going to buy them a lot less 25 years from now. And so they have to ensure that their income is going up in order to keep up with the rising cost of living. And so again, I think that the natural question then that follows that statement is, how do I do that? How do I ensure that my income in retirement is going to be able to keep up with the rising cost of living? And so I will suggest that there are 2 main things that you can do. Number one is the thing that Jordan already mentioned, which is deferring your Canada Pension Plan and old age security to get the higher benefit amount, because of the fact that those pensions are adjusted each year with inflation. They increase with the rising cost of living. That type of pension, a guaranteed defined benefit pension that is adjusted each year with inflation, is very rare. Many decades ago, companies would provide them as part of your job, but it's almost non-existent today. And so because of the fact that the government is giving us that kind of pension, we don't want to take a reduced benefit amount if we don't have to. The second way that you can stay out ahead of inflation is to invest at least a portion of your portfolio in the global stock market. Stocks historically have been our best tool to stay out ahead of inflation. And so on this chart, you can see inflation has caused the prices of goods and services to be about 2.25 times more expensive than they were back in 1988. Over that same period of time, the global stock market has increased by about 15x, which means that, again, a portfolio of stocks has provided a significant return above inflation over that time. Now, I want to take a second and be clear here that I'm talking about investing in the stock market as a whole. There are some individual stocks that have had much better returns than this. There's a large majority of stocks that have had worse returns than this. And I'm definitely not advocating playing the game of trying to pick which stocks are going to do the best. Most people are better off just owning a small percentage of every single stock in the market in order to capture the average return of the market as a whole. This is what's going to give your portfolio the best chance to grow at a rate above inflation over the long term. And it reduces the risk of losing that purchasing power that I talked about in retirement. And the reason that this is important is because losing purchasing power to inflation, in my experience, is a risk that not a lot of people consider when they think about their retirement plan. Oftentimes I'll hear people say things like, hey, I'm retired. I want to move my portfolio into something low risk. Like maybe I want to invest in GICs. I've heard they're risk free and that the rates are really, really good right now. And the reality is that GIC rates are high right now, but inflation is also high. And what you can see is that historically, GICs have provided a rate of return that is actually pretty close to the level of inflation. And so what this means is that if you decide to invest in something like GICs, you're not actually lowering risk in your retirement plan. What you're doing is trading off one kind of risk, which is the short-term ups and downs of the market that are a normal part of investing. You're getting rid of those, but instead exposing yourself to the long-term risk, which is losing purchasing power to inflation throughout retirement. And so therefore, in retirement, you need to plan for the fact that things are going to be more expensive over time. Prices are going to go up. And so you should consider investing at least a portion of your portfolio into the global stock market so that you're getting some growth, which will allow you to stay out ahead of inflation. So hopefully that's clear for everybody. Let's jump over to our next topic, which Jordan is going to speak to you about, which is a common rule of thumb known as the 4% rule. And I was so glad to see that a few people referenced it in the answers earlier. So Jordan, why don't you unpack this for us and how this works?
Awesome. Thanks, Phil. Yeah, it sounds like we have a few that are already kind of familiar with the concept of the 4% rule. And just as Phil kind of did previously, we're just going to get a bit of a check-in on where we are at this part of the presentation. And we've looked at the expenses of that are going to be in retirement, and then also what those that spending, what portion of it's going to be covered by some government benefits. The next is that portion that won't be covered from government CPP or old age security. How is that going to be covered, and what does that look like? So for some, there's going to be company pensions that can cover a large portion or a bulk of the difference, but these are becoming fewer and fewer and are really kind of focused in with government positions. So that leftover spending for a lot of individuals is going to have to be done through or provided by your investment portfolio and your investment accounts. So there are a lot of rules of thumb or guidelines that are out there. The 4% rule is definitely one of the more common ones, and it was really kind of the origins of it was kind of taken from a research paper from William Bengen. He was a financial planner, and at the time his research was done in 1994, and at the time he was just looking for a way to determine how much his clients could safely spend in retirement, and there wasn't really a lot of research or tools available at the time to kind of come up with any consensus or any answers to that. So he kind of had the ability and kind of the mind to kind of go through and kind of do this fairly in-depth research. And kind of so in practice, how it works is the rationale is that you can spend 4% of your portfolio, the value of your investment account, in year one of retirement, and then adjust it going forward by inflation. And this will support your spending throughout retirement with a very low chance of running out of money. So that's kind of the practical sense of it. And one of the big appeals of this is the 4% rule is really, it results in a single number. So there's a lot of simplicity behind it. So if for example, if you know that you need $40,000 from your investment account at retirement, the 4% rule will state that, okay, that you need $1 million in your investment account at retirement. So again, very, very simple, kind of one time, and very further or very little analysis needed beyond that initial kind of 4% calculation. So again, a lot of simplicity behind it, and that's drives a lot of the value. But with that, there's also a lot of some drawbacks to this kind of this rule and this rule of thumb. And one of the things we want to kind of just bring to your attention too is that we actually had the opportunity of having William Bengen on the podcast that Phil had mentioned previously, so the Rational Reminder. And this was back on episode 135, which I believe aired in February of 2021. And he talked a lot about his original research, as well as how he kind of works with clients and kind of incorporating this, but also kind of doing a lot further analysis. And then also talked about some scenarios where the 4% rule may not be suitable and what that could look like as well. So again, if there's anyone who's kind of interested in some further details or further dive into this topic, I definitely recommend. And I think Jordan just shared the link to it as well. And kind of going back to some of those drawbacks that are inherent with the 4% rule. So we have here, being based on U.S. data. So that's one of the big ones. It was the research, initial research was done between a period of 1926 to 1992. So and really focused in on the U.S. market, so strictly being invested in the U.S. market. So this was, because of this limited scope, it's very hard to, confidently, project that this is going to be similar markets going forward. It also happens to be a time when, the U.S. market was, had exceptional returns. So if you were invested or living in a different country, the results can be drastically different. And one of the other issues that also kind of comes up with it is it only covers a 30-year time frame. So we've talked a little bit about it, but with life expectancies increasing and early retirement becoming more prevalent, that 30 years may not actually represent how long your retirement lasts. And so that's another big one that kind of is underlying the 4% rule. And it's kind of with the analysis that was done, they had to, William Bengen had to do, there's a lot of assumptions kind of baked into that. So this related to, whether it be the portfolio you were invested in, so the accounts of your investments, as well as your tax situation. All these had to be, made assumptions. So it definitely doesn't incorporate everyone's individual specific circumstances. And one of the other big things that we kind of see with this is the simplicity is definitely an attraction of this rule. It also kind of comes with very mechanical and inflexible kind of guidelines as well. So one of the things that was brought up was that the 4% rule kind of has a stated spending level, and then that increases going forward by inflation. So what you'll end up seeing is your spending is going to keep pace with inflation. And Phil and myself, that's something that we see is not really relevant or doesn't really match what happens a lot of times in a practical sense. So a lot of people enjoy spending a little bit more in their early years of retirement, whether they're still moving a bit more and like to travel a bit more. Another one of the big issues that kind of come with that is it doesn't really reflect some of the other I would say complexities of life. So there's a lot of things outside of the portfolio. The 4% rule is really meant to look at the portfolio and strictly the portfolio. So it really doesn't incorporate a lot of other things that kind of can happen, whether that would be an inheritance that happens in life, or maybe you downsize your home. Another one of the big things too is that we kind of see people being a lot more flexible than needed with rules like this. So if markets are down and there's someone's looking to purchase a car and markets have performed poorly, maybe they push out that car purchase a year or 6 months just to be in a better footing. So we see a lot more flexibility kind of within individuals, as well as these other assumptions that kind of can really make a difference on versus what the 4% rule will come out. And kind of taking all this into consideration is one of the reasons why like Phil, myself, and the rest of the team really, rather than looking at these rules of thumb and kind of rigid guidelines, really focus on individual retirement spending plans that are really tailored to the individual and their circumstances. And Phil, for this next little bit, is going to go over some of the ways that we evaluate how that looks and if that's going to be a successful plan in retirement.
Yep. Awesome. Thank you. And Nathan, hopefully I see you in the chat there. Hopefully you're able to get logged into the software. the code, I'll put the code back up on the screen here for everyone that wants to answer the last couple of questions that we have as well. And so our final topic, I would say, is the question that we receive the most frequently when we talk to people about their retirement plan. We received it a lot last year in particular, which is the markets are doing poorly. And so how do I know that I'm still going to be okay in retirement? And so let's kick this section of the presentation off with another question for the group. And so, yeah, Nathan, thank you for bringing that to our attention. Anybody that wants to log in and answer the question, you can go to menti.com and the access code is at the top of the screen there. And the question is this: true or false, two retirees with the same size portfolios and the same withdrawal rate will have the same outcome if they both average returns of 6% per year? What do you think? Is that true or is it false? I'll give everybody a second here. If you think it's true, don't be afraid to answer that it's true, even though the majority of people are saying that it's false. You don't have to follow the herd. Oh, see, I say that, and then a bunch of true answers start coming in. There we go. Hopefully that made you feel empowered just to, yeah, answer what you actually think. So even though I encourage you to answer true, the correct answer is false. The group was right in this case. And so, as we are likely all aware, the stock market has appreciated over time on average, but it does not go up in a perfectly straight line every single year. It's a normal part of the investment experience for there to be years of negative returns, even if we look back on, say, a 20-year period and the average return over that period was positive. And so the challenge, though, is that when you're thinking about your retirement plan, the sequence of returns that you receive, so the actual returns that you receive on a year-to-year basis, can have a large impact on your portfolio, even if you get positive returns throughout your retirement. And so I've got on the screen here an example of what I'm talking about. This chart shows us two investors with the same portfolio value at retirement. They both have $1 million. They're both going to withdraw $50,000 per year throughout their retirement. And they're actually both going to average a 6% per year rate of return on their investment portfolio. That's going to be their average. The important difference here between the two is that the investor on the left, so the one in sort of the gray-blue section, is going to experience really, really good returns at the beginning of retirement, followed by poor returns later on. And so what you can see as you look at the value of their portfolio is that even though they're drawing $50,000 per year, the portfolio is actually still growing because the returns are so good early on that the investment return is covering the entire $50,000 withdrawal, and the original principal of the investment is growing. And so even though investor number one here starts to suffer poor returns later on, at age 90, they still have $2.5 million left over. Their portfolio has actually grown in retirement. Investor number two on the right experiences the opposite. So they have poor returns early in retirement, followed by great returns later on. And what you can see is that the poor returns early on in retirement actually cause investor number two to run out of money early. They unfortunately have to go back and be a greeter at Walmart or something along those lines. Now, the reason that I wanted to bring this up is because all too often I have seen in my experience, and I've been in financial services for over a decade at this point, and very often I see plans, retirement plans from other firms where they just assume an average rate of return on the investments and assume that the investments will make that average return every single year in a straight line up and to the right. So they'll say, okay, here's your plan. We'll assume you make 5 or 6% per year. And the assumption is that the investments hit that 5 or 6% every single year. And this is a very dangerous assumption to make, because what we can see is the sequence that you get that average return is very important. And so we have to find a way to account for that in the retirement plan, because it will have a huge impact. And so at PWL, we do account for this in our clients' retirement plans. And the way that we do that is by running the plan through what's called a Monte Carlo simulation. The way that this works is that we enter both an expected return and risk assumption for our clients' investment portfolios. And we then run hundreds of simulations of different retirements where the returns on the portfolio vary from year to year. So we basically, just to go back one chart, we basically recreate this chart hundreds of times over. And what we do, just to give you an example of what the results look like, is we look at the percentage of the time that our client was able to achieve their retirement goal versus the percentage of the simulations where they would have to make adjustments in order for their plan to be successful. And this allows us to determine whether the plan is still going to be successful and on track, even if the market returns are poor in the future. And so this is one of the ways that we can account for that sequence of return risk. And it's a way that, by having this, you can bulletproof your retirement plan against potential market downturns in the future. And so that concludes the prepared content for today. A couple of last things, though. If you think that this type of planning for retirement that we have talked about today would be helpful and valuable for you, and you want some help, I want to let you know I've actually specifically blocked time in my calendar for the rest of this week and into next week for anyone that has attended today's webinar and wants to book a call. I'll be happy to talk with you about your specific situation, learn some of the details of what's going on, and see how I can help. There might be an opportunity for us to work together, but at the very least, I will try and point you in the right direction. So if you would like to book a call with me, you can actually click the link on the screen that is there. And I think they're going to actually post the link in the chat as well. So either one, feel free to book a call. Would love to chat and see how I can help. And I'll just leave that up for a second for anybody that wants to click on it and schedule a call. And then the other thing is that we would love to get your feedback on this presentation. We'd love to hear what you liked, what you found helpful, what you didn't like, what could have been explained better, and also get any suggestions that you, the audience, have around topics that you'd like to see us present on in the future. We'd love to get your feedback. So feel free to either scan the QR code that you see there on the screen, or just click there on the blue where it says link to 3-question form, just 3 questions. Feel free to click on that and give us some feedback. Jaspreet, do GICs help markets being risky? So yeah, again, just to go back to that section a little bit, GICs are helpful if you're going to use that money in the short term, because again, it's this trade-off, right? It's trading off one kind of risk for another. So if you've got a pot of money and you're planning on using it to buy a car a year from now, and you want to park it somewhere, buying a GIC to earn some interest, and then it's going to mature, and then you can go and buy your car in a year, that's a great solution for something like a GIC. Because even though the GIC might not provide as high a return from the stock portfolio, that's okay, because that sort of opportunity cost is only happening over a very short period of time. And so it's not really going to make a big difference to you achieving that goal. But if you invest in lower risk investments like cash, money market, GICs, any very, very low risk investment, it's probably going to have a low return over the long term. And so over, say, a 20, 30, 40-year period, which most of the examples we've talked about today are people retiring at 65 and living into their 90s. So we're talking about money that's going to be invested for a 20, 30-year horizon. And so keeping money in super low risk, low return investments mean that you're subjecting yourself to losing purchasing power over the long term, which can have a big impact. So hopefully that helps. Hopefully that helps explain that a little bit. How about the psychological mental shift required upon retirement when you are switching from accumulation mode to depletion mode? Yeah, so Dwayne, that's a great point, and definitely one that we see a lot. In my experience, what I tend to see the challenge there for most people is, if you've got that accumulation mentality, you're a great saver. it actually can be hard to then flip the switch and start spending money in retirement. And so in some cases, we see it where the risk for some people is not running out of money. We run those Monte Carlo simulations all day. The success rate is 100%. Even if the markets do terribly, they're at no risk of running out of money. The risk there is not enjoying your retirement enough. Like maybe you could do more travel, help your kids, donate to charity, like do more in retirement. But if you don't flip that switch, that can become a challenge for some people, and is definitely something that I have seen.
I think further to that as well, Phil, I think that's something we explore a little further, I think in some other presentations as well. I think one of the key presentations I think that will be coming forward is it's kind of a finding and funding a good life, which is kind of on that topic as well, kind of less so more so on those issues versus the the spreadsheet kind of answers that, or those planning topics. So that's something to look at as well. Dwayne, is there should be some more kind of content on that as well that is available.
Yeah, it's a great shout, Jordan, for sure. The next one of these webinars is going to be based on the material from one of the white papers on our website, Finding and Funding a Good Life. Highly recommend reading the paper. It's all about how do we spend money on the things that deliver true happiness. And if you've worked hard, you've saved hard, you're now retired, you want to spend the money on the things that are going to make you happy. And so the presentation will be all about, a lot of the research around the things that make us happy that we should be spending money on, and a lot of the things that we kind of oftentimes unconsciously spend money on that maybe don't bring a lot of joy and happiness. So look out for that online for when that presentation is going to happen, because it'll be great for sure. Let's see, Albert, I am probably too pessimistic, but I think RSP may not be a good saving strategy, especially when one starts to withdraw money upon retirement. The details are in the tax rates. So Albert, I will respectfully disagree. Definitely, you want to make sure you're using the RRSP properly, but the RSP is a program. It's an incentive that the government gives us for retirement. Again, we've got lots of great, I know Jordan Tarasoff, who's been monitoring the chat, actually has a great blog post, an overview of how the RSP works and some of the benefits. The RSP is a tool in your belt that's going to help you save tax over your lifetime if you use it properly. You're definitely right that the devil's in the details. You've got to make sure that you do use it properly to benefit from it. But I would say for the vast majority of people that are living, working in Canada, the RSP is a beneficial tool that will help. And so feel free, reach out to us, book a call. We'd be more than happy to chat about RSPs and how they might factor into your specific situation. Let's see, we've got a few minutes left, so I'm just reading through the chat here. Daniel asked, what tools does PWL use for running Monte Carlo simulations / testing retirement plans? So we have some great financial planning software that we use, Daniel, that includes Monte Carlo as part of it. The thing with Monte Carlo is it is all about the quality of the inputs that's going to determine the quality of the output, of course. And so, again, if you want to check it out, feel free to give us a shout. Let's see, did I miss any? I don't think so. Oh, I see Adam's question. If you're maxed out on RRSP and TFSA when you retire, what is the optimal strategy to withdraw from those or keep contributing along with non-registered accounts? So if you're maxed out when you retire, what is the optimal strategy to I think I see what you're saying. So yeah, this is a question. We actually are looking at doing some additional research on this. And I believe this is something our research department is working on currently, which is what is the optimal way to decumulate your assets in retirement? So should you draw from your RSPs first, your TFSA, your taxable accounts? How does that all work? It's a great question, a very tricky math question that, again, is really going to be dependent on the situation. I'm thinking that there won't be a rule of thumb that applies to everybody. But yeah, I see Barrett's comment here. Decumulation strategies would be a great future presentation. We'll note that and keep that in mind. And Dwayne agrees. Okay. Well, if everybody wants it, then we'll start working on it. Any last questions? We got 2 minutes left. Okay, well, it looks like, oh, I just see Maria. Hey, Maria, thank you. Yeah, thanks, Baird. And thanks everybody for attending. We hope you found this helpful. And please come to the next presentation. Please reach out. Great to see everybody. And we hope you enjoy the rest of your day. We'll sign off.
Thanks, everyone.